Good evening or good morning, traders and investors, depending on when you're watching this video. It's Will back here with another one. Hopefully you guys had a very decent day in the market, despite the fact that nowadays it's very tough to be a tech/growth investor. Yes, today was another day of brutal sell-offs. Largely no headlines at play right now. No, only a further deleveraging of some of our favorite tech names. If you take a look at the Mag 7 list right down here, you will see that again today, other than maybe Apple, Microsoft, and Netflix, which had nice little moves today. We had further deleveraging. AMD had great earnings yesterday, which we covered on the channel. That one was down 17%. A little bit of an unwarranted sell-off, but it is what it is. Amazon down 2.34, Google down 2, Meta down 3.28, largely erasing all of its earnings gains, and the sell-off continues. Even NVIDIA down 3.41%, Tesla down, Palantir down 12% on the day, and it does not stop there. SOFI, which had very good earnings, we covered them yesterday too, down 4.64. Uber, 5% to the downside, and another slide after they reported their earnings this morning. Now, that being said, guys, right, doesn't stop there. Take a look at the list of high growth tech stocks right here. IREN, anything from AAPL, SanDisk now actually coming down. We know SanDisk has been on an absolute tear, but now memory stocks also starting the great unwind. Look at these weekly time frames, not looking good on SanDisk, and even Micron, right? Big weekly engulfing move too. That being said, the list just goes on and on and on, whether they are data center networking plays or possibly the critical minerals plays, which were very fun. And some of the other tech names too, even some energy names like FLNC, which had their earnings today after the close. They were down 10 and then another 10 in the after hours too. We talked a lot about those battery stocks, everything from CoreWeave, Nebius, and the list goes down and down and down. Reddit suffering another decline today, 7.5. Robinhood, another 7.41% to the downside. Look at this list. Absolute destruction in the tech/high growth landscape. So what exactly is happening in the markets, especially because the equal weighted SPY did really well today, 0.87% to the upside. If you take a look, financials did well, healthcare did really well, the consumer defensive segment of the market did really well, 1.3%, staples, right? And even consumer discretionary retail up 1.4, let alone real estate up 1.5, and energy names up 2.25. So if you were to just look at the S&P alone, you might not think that anything is happening. But as the title of this video says, there's a bit of a silent market crash going on. Maybe not so silent if you're keeping abreast of things in the market every single day. But if you're just a normal ETF investor, you may not see the problems that are happening behind the scenes right here. So in today's video, we're going to explain what's happening. And there's a big deleveraging event going on in the markets right now. And it all started with these last week. It all started with good old silver and gold. We saw the massive deleveraging events last Friday, and it kind of cascaded into the early portion of the week. And mind you, even though silver and gold didn't have a bad day today, look at the futures on gold right now, down 2%, and silver down 13%, testing some of those Thursday and Friday lows. Big deleveraging event in the market right now, and they're just moving on from asset to asset. All of the crowded trades being unwound one after the other. On Friday, it was the metals. Yesterday, although software isn't a crowded trade, they unwound software even more, basically off of no headlines, which we took a look at yesterday in the video as well. And then today is pretty much everything else. Big tech continues to crash, and now they're targeting, well, the market is targeting a lot of people's favorite growth stocks, right? Even semiconductors. So the paradox continues right now. SaaS companies are being unwound because of the AI narrative, but then all of the companies that are enabling the AI narrative, well, they're coming down too. And it's like we're in a situation where, can you really have both? Software names being eroded by AI, but then the AI names also being eroded on their own. A very peculiar market, but it all has to do with a few key things. So in today's video, we're going to talk about all those things. Number one, we're going to go over some news elements from the day and some charts just to show you guys where we are currently and what might be behind the cascading events in the sell-offs in big tech and small tech overall in the past few days. Thereafter, we're going to get into two company earnings that I've prepared for you guys. Number one is going to be Uber, and the other one is going to be Google. Now, shout out to all the other companies that reported earnings today, but just to save some time on the video, today we'll be doing Uber and Alphabet. Tomorrow, we're probably taking a look at Amazon, IREN, and perhaps one of these three down here, Reddit, Bloom Energy, or Affirm, whichever one I deem to be most notable for the channel. After we're done our earnings, guys, we'll take a look at our indexes and check on the rotation because, surprisingly, the rotation today was actually very good. If you take a look at the breadth indicators here, percentage of stocks above their 20-day EMAs, it was fine. Percentage of stocks above their 50-day EMAs actually went up, and percentage of stocks above their 200-day EMA, that too went up, which led to a heat map that looked like this. Massive destruction, tech, software, semiconductors, but the rest of the market green. Matter of fact, 70% of all stocks in the S&P today were green, and not only small green, big green at that. So we'll take a look at the market rotation on the indexes. Thereafter, we will get into our big tech name list down here, and derive which of these names are still in great buying opportunities. I mean, quick little hint, right? A lot of them are in very attractive levels to buy. And at the end of the video, we'll spend some time talking about the biggest gainers and losers and where I think there could be some interesting plays coming up in the near-term future. So it should be an action-packed video, guys. Took me a long time to prepare this video. My apologies for releasing it so late at night, but I had to prepare the earnings, had to listen to many different earnings calls, and just get a sense of what happened in the market while I was sleeping. Obviously, I'm on Asia time right now. I'll try my best to put the videos in the future at a earlier pace, but when you have such a big day of declines like this, you know, it takes me a while to just basically cross the T's and dot the I's for everything that happened all throughout the evening. So that being said, guys, let us get into today's video. It should be a very action-packed and a very fun video. So let's get into it, shall we? So the S&P down 0.5%, the Q's down 1.75, and as I said, taking a look at the heat map right here, you'd be hard-pressed to find anything wrong with this market breadth. It's very good market breadth. Unfortunately, for many people who are tech and growth investors, and myself included, the past few days have really not been kind to us. But not only the past few days, let's call it a majority of the last 3-4 months, right? There's been some pockets of tech that have been very good. However, large swaths of the tech environment over the past 3-4 months has not been good. And we've been noticing that, right? The QQQs have been stuck in a 3 to 4 month range. Very, very choppy price action. But the key themes and sector rotations that we were talking about throughout the month of January, which would be the initial 2026 themes, they've been doing very well. Financials, another good day. Healthcare, for the most part, another good day. Consumer staples continue rallying, right? Industrials and real estate utilities, energy stocks as well, continue to do very well. And that was part of the rotation. Even though Amazon, Google, and other names, Meta, NVIDIA, all those good tech names are dropping, I mean, where's the money flowing into? You got very boring stocks, right? Look at Altria, up a ton, right? Look at Target of all companies, right? A company that has so many execution problems, that's doing phenomenally to start off the year. Companies like Walmart are progressively higher. Look at Walmart's chart. No problem here whatsoever. And the list goes on, right? No matter which consumer staple stock you choose, it kind of has the same chart. And even in XLE, right? Some of the energy players, oil and gas, very boring companies as well. Look at Chevron going for the massive breakout here of a 4-year downtrending range, right? Into even names like ExxonMobil. There was a 4-year range, they were stuck, and now big breakout. So a lot of boring stocks, maybe some stocks that people don't have too much exposure to, they're doing really well. And then large cap and even mid cap tech stocks are doing very, very poorly. Moving on to the one-day relative, you can see that even better to where communication services, tech, consumer cyclicals, utilities, all took a big candle to the downside. Consumer cyclical on this chart, you know I presented the XRT. XRT is a very fun consumer retail ETF because it doesn't have overweight positions in names like Amazon, whereas if you just measure this chart right here, consumer cyclical, well, that has to do with the large market caps of Amazon and Tesla in the consumer cyclical demographic. That being said, look at the rest of the sector. The rest of the sector did very well today. Nike was up 5.4%. Right? And a whole host of other names, McDonald's, Starbucks, Chipotle, all, even the hotel names, right? All up, except for Amazon and Tesla leading the sector to the downside. Unfortunately, to the upside, real estate, energy, defensives, healthcares, and financials. You have seen this one-day relative performance so many times throughout the month of January and even in the end of the month of December, which gives you a very bipolar and bifurcated market. The one-week relative performance shows that even better. The same sectors as on the one day are printing the highs, and the same sectors that have been weak so far this year, technology, some of the cyclicals, right, led by Amazon and Tesla, communication services, all to the downside, unfortunately. So what does this all mean in the context of the rotation? Well, we talked about it many times throughout the month of January. I'm not going to make another 2026 themes, stocks, and sectors to look out for. You guys know that so far. But why are we getting these big liquidation breaks that started last Friday with the silver trade? Well, there's a few key reasons right here, right? Number one has to be the period of time that we're in right now, right? So number one, we are in a midterm election year, guys. And keep in mind, find midterm election years can be very volatile and can be very choppy overall. Here you can see a chart of all other years versus a midterm election year. As you can see at the beginning of the year, it's very, very choppy. January, February, and even into the early stages of March before mounting a nice little recapture here to the upside in the end of March towards April. And then the summer is also quite challenging leading into the actual midterm elections. But that being said, there's a few other things going on here. We can see the midterm election year chart even better, right? To where first year in office is pretty good. Midterm year is that choppiness. Pre-election year and then the election years continue to be somewhat more smooth in terms of trendiness. But here's one of the big problems, right? The problem is there's a lot of margin debt. And we brought this one back up in the month of December as one thing to kind of look out for, right? Margin debt is now outpacing the S&P 500 gains by 20 percentage points year over year, the widest gap since the 2021 meme stock frenzy. But it's not everything. As you can tell from the heat map, it is very targeted margin. People are crowding into the very same trades, not the institutions because they know better, but retail especially. What we're seeing right now is probably a liquidity flush, essentially, out of the markets, getting people margin called and things like that. The price action recently, guys, big moves down at the open. Even though the pre-market can be fine, you open the market and then a lot of our favorite names go down 5, 10, 15% instantly and kind of either keep dropping or stay low all throughout the day. That is liquidity hunting by the algorithms, in my humble opinion. Big margin calls being issued probably for retail right now. Here is your picture of the margin debt accumulated into 2026. You got another chart right here. Excessive increases in margin debt have preceded equity bear markets. However, this is not an everything margin market. This is the difference, right? I'm not saying that this time is different, but there are certain elements of this time that are indeed different. The margin seems to be very concentrated into the same retail fan favorite names, right? Whether those are small or mid cap names, or whether they are the metals trade right now, etc., etc. So please keep that in mind. But what we're seeing right now, because of these levels of margin, definitely looks like liquidity hunting, stop loss hunting, and just overall margin flushes out of the system. That being said, guys, an interesting statistic here. The S&P went down today, but more than 70% of its stocks were up. This bullish breadth divergence has only happened 11 times before. 10 of those instances led to a S&P rally 3 to 4 days later. And here are your statistics. Traditionally, other than the actual bear market of 2022, this has led to rallies as the market breadth will tend to prevail. It would be one thing if this heat map was the opposite. And this was the problem what we had in October. You might remember the last time that the SPY and QQQ had a little bit of a rapid sell-off, right? And that was in the end part of October into November when the S&P went down almost 6% and the QQQs top to bottom right there went down almost 8%. This heat map was the complete opposite. At that moment in time, we were dealing with concentration issues. Everybody was only in big tech and AI names, and the rest of the market was doing nothing. I much prefer this style of a market because it's concentrated selling off in certain key names, but the market breadth is very good, which shows you that the big money is not exiting the market because they're concerned about the macro or anything like that. No, the big money is just rotating right now. And unfortunately, because they're rotating, there's not as much liquidity in some of these names that people have been very bullish on and leveraging up in. So as a result, you're getting big sell-offs. And you can see that even better in a few of these charts that we're going to go through in the next few moments. But let's continue on to further news elements that happened today. So right here, you have President Trump coming out and saying, I think Warsh understands I want lower rates. He wouldn't have gotten the job if he said he wanted to raise rates. So this once again kind of putting to rest the concerns that people had last Friday upon Warsh's nominee for Fed chair. A lot of people said that the sell-off on Friday was driven by the market not reacting very favorably to Warsh, saying that he was a hawk and that he wasn't going to do interest rate cuts and things like that because of policies that Warsh had held about 15 to 20 years ago. Supposedly now he's a changed man, and as I was saying after Friday's sell-off as well, I'd be highly surprised if President Trump would nominate somebody for Fed chair after criticizing Jerome Powell for so long for not dropping interest rates. I'd be highly surprised if he nominates Warsh without there having been big conversations between him and President Trump in terms of the interest rate cycle. So please keep that in mind. So once again, I don't believe the sell-off is due to Warsh at all. So we can kind of put those concerns to rest. No, it all started as a liquidity flush in the commodity sector. And yesterday, they targeted software, a lot of software names, and even pouring into names such as Palantir or other things like that, and large cap tech too. And today, they just targeted everything that was tech. Software, as a matter of fact, recovered today, but now they rotated that sell-off into semiconductors, small and mid caps, very popular names, and big tech, unfortunately, not able to keep it up either. Moving on further, we have more news from President Trump today, speaking about a phone call that he had with President Xi of China. So no geopolitical current risks right now between the United States and China. We know that that can often rock the markets, but the sell-off is not coming from here. So we're kind of going through the elements one by one, right? It's not Warsh, it's not China. Clearly, right? So they spoke today and talked about many things such as Taiwan, the war between Russia and Ukraine, current situation with Iran, the purchase of oil and gas by China from the United States, the consideration by China of the purchase of additional agricultural products, including soybeans, airplane engine deliveries, and numerous other subjects, all very positive. So speaking very positively, as a matter of fact, about that relationship with China and looking forward to his visit in April in the country. Keep that in mind. So we're kind of going through every single thesis that could possibly be dropping the market right now. And the only one that really makes sense is it's a big leverage flush, right? A big concentrated leverage flush into very popular themes of 2025. And basically making the pivot, as we've been talking about this entire month of January, making the pivot into all of the rest of the market combined. That being said, moving on further here is the continuation of the decline between software and semiconductors, but you'll notice the SMH today was down a whopping 4%. How did software do? Well, software started off the day really bad, but you can see here, we might just be approaching a local bottom, as it did flush early on in the morning, but then the bulls were actually there to buy the dip. And some names, not all, but some names starting to recover a little bit. Now, a 3% move on Adobe after being down 20% in the last 3 weeks doesn't mean much, but just to show you, right? They're starting. They might be starting because the mean reversion trade is definitely going to be one to keep an eye out. This is your prime book exposure by Goldman Sachs. Total U.S. net exposure to software in blue versus semiconductors in red. We know that one trade has been wildly popular, semiconductors, and one trade has been an absolute disaster, software. And this all started mid-2025, but accelerated in October of 2025. So keep that in mind. There may be a mean reversion trade, and we're kind of starting to see glimpses of that, right? With a lot of these semiconductor trades being very extended. Look at ASML. ASML starting to roll over. Micron starting to roll over. I'm not calling for the full rollover, but you're noticing these, right? Whereas these weekly candles are rolling over, some of your software candles are starting now, just now, to try and turn things around. So one day it's not enough to say that the actual pivot is happening, but definitely something to pay close attention to, right? Moving on further, here's your software versus semiconductors relative to the S&P. As you can see, the software performance has been absolutely abysmal, whereas the semiconductor performance has been great. So if you're looking for alpha and you're looking for rotation, pay close attention to this rotation, guys, because it is happening in front of us right now. And here's another last chart for that. Long hardware, short software has been a very popular trade, but maybe we're coming to the tail end of that unwind. ETF tracking U.S. software sector falls 19% over the course of the past year. So this is a 1 year comparison, 19% down for software, and the chip stocks have rallied a whopping over 60%. So that's massive outperformance, right? There may be a bit of a mean reversion trade to be had right here. Now, speaking about this software trade, because everybody under the sun thinks that a lot of these software companies are just going to go bankrupt overnight, we've talked about some of the concern, obviously, the seat risk slash licensing risk, the productivity and efficiency gains will require potentially less people to do the same amount of work, and as a result, you need less licenses from these SaaS companies, et cetera, et cetera. That's probably the biggest risk to the software trade right now. Also, the loss of predictability for earnings, because of a lot of the risks associated with software. Well, we only have to look to some of what the tech leaders are saying. And Google just had earnings today. And as a matter of fact, Sundar Pichai talked about software in the earnings call today. Here's what he had to say. From my vantage point, I definitely see we have very, very good SaaS customers who are leaders in their respective categories. The successful companies are definitely incorporating Gemini deeply in critical workflows, improving their product experience and driving growth, or using it to drive efficiency within their organizations. I think it's an enabling tool. Pay attention to the word tool, because this is going to come back in the next slide that I have for you here. Be it search or YouTube. If I look at it in terms of their token usage, the growth has been very robust in Q4. So saying that SaaS companies are using AI in terms of being able to deploy AI very effectively for their businesses and retaining their customers. And who else had something to say about this? Well, Jensen Huang was on a panel just the other day, and this is what he had to say about software, comparing them as well to comparing SaaS companies to people who use tools effectively, right? So take a look here at some of the quotes. If you're a humanoid robot, artificial general robotics, would you use tools or reinvent tools? The answer is obviously to use tools. And so now do the digital version of that. If you were an artificial general intelligence, would you use the tools like ServiceNow and SAP and Cadence and Synopsys, or would you reinvent a calculator? Of course, you would just use a calculator. So Jensen Huang saying largely that the narrative against software right now doesn't really make sense. And he did go on to say that these companies would stand the test of time and that eventually the market would come to understand that. So keep that in mind for software as well, which is why a lot of the software companies, I'm not saying that all of them are a buy, but some of them could be very decent little pickups here indeed as well. And now lastly, moving on further here, we got one last piece of news that I thought would be interesting for you guys. TSMC, more news for them, planning a $17 billion investment in 3nm chip production in Japan. Very strong. So TSMC diversifying their bets. A lot of their fabs recently have been built in the United States and now doing one into Japan as well. So that is everything I had for you guys for the news presentation. Just focus on the leverage, because in my opinion, guys, it is indeed a big leverage flush out right now in some of the former favorite plays from the market in 2025, and now you're seeing the key sector theme rotations into everything else. And pay attention to it, right? The Russell was down a lot less than the QQQ. So currently this year, it's still a pivot to energy, value, and defensive names, but also the Russell, small and mid-cap names, despite being destroyed today, have been holding up really, really well. Better so than the QQQs. Take a look at the Russell's chart, and then take a look at the QQQ's chart. You can clearly see that one has been clearly outperforming the other, so keep all of that in mind. So before we get into actual charts, guys, I know it was a very long introduction, but these things need to be said. Before we get into more charts, let us move into our earnings that we have prepared for you guys today. I'm going to start off with the biggest one of the two that we have today, Google. Now, Google reported earnings, guys, and they did miss on certain very little elements, but overall it was a very solid report, and we're going to move into that. But you can see what happened here. Initially, when they reported, Google got the Microsoft treatment as well. Initially, they were down 7.5% before the market kind of ran them up higher, flushed them again, and then they ended the day pretty much exactly where they closed. So no change after Google's earnings, but Google's earnings were absolutely fantastic. Absolutely fantastic. So if we'll take a look at the numbers real quick, they beat on EPS by 7% and beat on revenue by 2.25%. And the CapEx story for Google was massive. Just Google's CapEx and what Meta said, what Microsoft said last week, lets you know the AI trade is nowhere close to being finished, despite the price action that you're seeing all across the board in tech and AI right now. This trade is very much still alive, and the money being deployed for this trade is very much still present as well. So let's move into the Google earnings. So some of the numbers from Google, guys, were absolutely fantastic. Let me just move my big old head over so you guys can see this right here. As you can see, right, total revenues was a big beat, 2.1, as we said, year-over-year growth, 18%. Look at search. Search business definitely not going anywhere anytime soon. They beat on their metrics, but also was a gain of 16.7% year-over-year. YouTube was a miss, unfortunately. However, still gaining 8.7% year-over-year. Network from Google also down 1.6% year-over-year, although they beat, it was down year over year. So you see, there's a few little elements here in this report, which makes it not a perfect report, but a very strong report nevertheless. Google subscriptions, that missed the estimates by 0.5%, but still up 16.7% year over year. Google Cloud, the biggest number of them all, look at these gains. Surprise, 8.7% on the beat metric this quarter, and year over year gains of 47.8%. Very, very strong indeed. Gross margins also came in at a 2 percentage point or increase year over year. You can see they're now up to 59.8% as Google becomes more and more efficient. However, operating incomes, right? Operating incomes were a little bit of a disappointment here. You can see that operating incomes missed by about 1.5%. 31.6 was the print, and they were expecting 33.1, and that was a decline year over year. So you see, the report is not perfect. There's some elements that you can criticize, but the cloud growth and the rest of the search growth and the advertising growth, which I'll show you. Well, I might as well just show you right now. It's not on that page right now, but I did derive it for you guys. Advertising growth was up 14% year over year. I mean, in Q3 it was 13, in Q2 it was 10.5. So advertising accelerating, search revenue accelerating as well. Cloud revenue was 48 this quarter, 34% last quarter, 31% the quarter before that. So it's very tough to criticize most of these Google earnings, but you can see the report is not absolutely perfect. And here is the guidance. Okay, the one guidance that rules them all, 180 billion CapEx midpoint guide for fiscal year 2026. The estimate was 120 billion. That is up almost 100% over last year. So clearly, and Google doesn't have a massive OpenAI partnership like Microsoft does or like Oracle does for these performance obligations. No, this is money that they're deploying for their cloud, for their search business, for other businesses as well. Massive amounts of capital being deployed by Google. So just to show you guys, right, the money is very real. And it's not as if Google isn't good for it either. Look at their free cash flow this quarter, 24.5 billion in free cash flow. The expectation was 15.6. That is a monstrous beat on free cash flow. Another great quarter for Uber overall. That big CapEx number towards the end is one that you got to pay attention to. Here's what Google's businesses look like on one chart. You can see search and other revenue, all lines of businesses performing very well. Network revenue was a little bit flat, but subscriptions in green right here was very solid, and the cloud revenue down here in the red category also very strong. So all lines of business for Google continue pushing higher and higher. Very attractive chart in my humble opinion too. The number of deals that Google has been talking about, the number of deals in 2025, over $1 billion, surpassed the previous 3 years combined. That's why they need all the capital expenditures, right? Moving on a little bit further to some of the earnings highlights here in the article. The company's CapEx spend will go towards investing in AI compute capacity for Google DeepMind and to meet significant cloud customer demand, as well as strategic investments in other bets. So they're not building this stuff out for nothing, guys. The demand is very real. It would be used to improve the user experience and drive higher advertiser ROI in Google services as well. Moving on further, advertising results were negatively affected by the lapping of the strong spend on US elections in the fourth quarter of 2024. So kind of justifying why perhaps some advertising revenue in YouTube and other segments were down a little bit, fractionally, not by much, right? The Google Cloud unit, the business's backlog increased 55% sequentially and more than doubled year over year, reaching $240 billion at the end of the fourth quarter. Massive amounts of backlog, and similar to what Microsoft said, right? And they just don't have enough. They don't have enough compute for all their clients, guys. It's very simple, right? The AI narrative is still very much alive, in my opinion, and in Google's opinion as well, or they wouldn't be spending that money, would they? Google's Gemini AI app now has more than 750 million monthly active users, up from 650 million monthly active users last quarter. Very strong print there as well. As we scale, we are getting dramatically more efficient, said Sundar Pichai, the CEO. We were able to lower Gemini serving unit costs by 78% over 2025 through model optimizations, efficiency, and utilization improvements. So not only do they have more customers, guys, but their AI models are getting more and more efficient by the quarter. Very strong earnings report from Google. Waymo took a $2.1 billion stock-based comp charge for the fourth quarter as it raised a new funding round at a $16 billion valuation. So kind of justifying why the other bet segment by Google right here had a slight little miss. As you can see, there's that other $2 billion. In the other bet segment, still a very small revenue driver for Google right now. The other bet segment, still a loss-leading category for the business overall, so keep that in mind. The self-driving wing of Alphabet ended 2025, having served 15 million trips in 5 major U.S. markets, including Austin, Atlanta, Los Angeles, Phoenix, and the San Francisco Bay Area. And in January, Waymo started beginning operations in Miami. So this I highlighted because we're just about to take a look at Uber, right? And you will see that it's not one or the other. Autonomous vehicles and ride sharing overall, the market overall is expanding. There's not cannibalizing one for the other, right? We're not cannibalizing actual human drivers with autonomous vehicles and the market staying the same. No, the total market is expanding, and we'll show you some statistics from Google in just a few short moments right now. So overall, guys, a very strong valuation. You can even go through their earnings slides. Tremendous prints by Google right here. $60 billion in revenue from YouTube ads and subscribers in 2025. Absolutely massive numbers all across the board. You'd be hard-pressed to find anything majorly wrong with this report. As we said, there was a few little missed elements right here, but nothing really dramatic for the business overall, right? So the revenue profile right here, as we already showed, but I just want to show you guys one big number. Is Google good for the money or not? I mean, you guys tell me, right? Ending trailing 12 months of free cash flow figures by Google right here, $73.2 billion in overall free cash flow. And I'll take you back to the previous, some of the previous slides as well. I mean, net income for the quarter, right? Pure profits, $34.4 billion. And for the full fiscal year 2025, $132 billion in pure bottom line net income cash. So Google is definitely good for the money. If they're raising CapEx, they're good for the money, and the demand is here, as we clearly saw through the cloud growth, for the backlog growth as well, and through the commentary by management. So that being said, a very solid earnings print from Google. Although they are slightly flat in the after hours today and the chart is extended, this company is excessively solid. At $330 right now, is Google a buy? Well, it's top end of the range for me, right? It's a 29.2 forward price to earnings. And that being said, they are growing revenue and EPS at very attractive rates. It's a 1.95 peg right now, and the free cash flow yield is a bit low at 1.82%. But I'll remind you, the free cash flow yield is just an expression of free cash flow divided by the market cap. So the only reason that this low is not because they're not making any free cash flow. No, it's just because the market cap has ran up so fast, right? Google's up like almost 2x from the lows, more than 2x from the lows in the past year alone. So that's why this free cash flow yield is a little bit low right now. So that being said, is Google a buy up here? For me, no. Google for me is a hold up here, just because it's at the top end of its historical valuation, on the verge of a 2-peg, 30 forward price to earnings. Can you argue that there is still some gains to be had on Google stock from here? Yes. But the easy money on Google has already been made. However, if we somehow get a decline on Google, as we know the market's been very good at sending very high quality companies down over the past month or so, if I can somehow find Google here in the maybe 280, 270 range. I'm not saying it's going down there. I'm just saying if they do the good old monthly retracement, as many companies have been doing recently, right? You can't say that it's never going to come, right? Microsoft did it. They pulled back to the EMAs when they were all the way up here. People said it couldn't be done. It happened. Meta, when everybody was super bullish at Meta up here, and I was saying, no, I'll wait for a pullback to the 12 EMA. People said it couldn't be done. I waited for it. They gave it to us, right? NVIDIA, when NVIDIA was grinding higher all the way up here in the beyond 200 range, I was saying, no, I'd rather wait for the 12 EMA. People said it couldn't be done. It's too bullish. Well, AMD, same concept when we were all the way up here after the OpenAI deal, and I was saying, no, I'll wait for re-entry on the 12 EMA. People said it couldn't be done. It can always be done, guys. It can always be done, even for Google. So keep that in mind. I'm not adding any shares. I'm not selling any shares either. Google for me up here is a hold. The business is executing extremely well, but am I going all in Google up here? No, I don't believe the risk reward is supportive of that right now. But that being said, that's everything I had for you guys for the Google earnings. Hopefully you enjoyed that. Now let's move into company number 2, which is going to be good old Uber. So Uber has been selling off from these $100 highs because of the threat of autonomous vehicles. But as I'll show you, or hopefully show you from this earnings result, right? It's not one or the other. Uber has such large network effects that they benefit from autonomous vehicles and the markets that they are creating, because it's growing the total market overall. And we will show you some slides from Uber to kind of support that argument right there. So unfortunately, Uber, over the course of the day, they were down 5% after their earnings print. Now, there was a few hiccups by Uber, but not many. As you can see right here, they missed on EPS by a wide margin, but I will explain why. It was actually a fake EPS miss, but one miss nevertheless, and revenue was up by a fraction here, 0.3%. So they didn't beat by much. They missed on EPS, although it had to do with miscellaneous items, and the revenue just wasn't probably high enough for Wall Street. As a result, the stock was down 5%, but the business is doing incredibly well. Take a look at some of the easy numbers right here in terms of Uber. As you can see, this revenue print, 20% year over year, very strong. Small surprise for the quarter, but very good year over year performance. Mobility was a slight disappointment this quarter. They missed by about 0.8%, but look at their performance year over year, 18.7%. That's very solid. Delivery, 3.7% surprise here on the quarter, 29.7% growth in delivery year over year. Extremely strong numbers. And Uber's freight division, it was a nice attempt by them, but still not putting up very good numbers right now. Year over year, a slight decline, as the service just hasn't really taken route yet. Gross bookings, I don't see a problem right here. 2% surprise on the quarter and 22.5% year over year. Very strong. Monthly active consumers, a very big metric for Uber. They beat on this quarter, but also year over year growth, 18.1%. Such strong numbers all across the board, guys. Double digits, right? Either high teens or mid 20s. Very strong numbers across the board. And look at overall trips. Can you guys believe that Uber did a total of 3.75 billion trips in one single quarter? Absolutely ridiculous, right? That's a beat for this quarter and a 22% beat, or 22% increase year over year. Adjusted EBITDA, that was a beat as well. 35% year over year increase as well. Free cash flow was very good, 2.8 billion for the quarter. The estimate was 1.92 billion approximately. That's a 64% increase year over year. So free cash flow numbers are very strong. I don't know if my head's in the way of those free cash flow numbers. No, they're not. And now we have Q1 bookings. So here is your estimate for Q1 bookings, right? Now, the actual number came out here. It would be an increase of 23% year over year. My head's in the way, I think, but I'll move myself over in just a minute here. And slight miss on future profit metrics, such as EBITDA, right? That was a slight miss by 1.5%. So you can see there's a few misses here, which can contribute to a bit of a share point decline. However, the fundamental aspects of the business are very strong. It's just we know that Wall Street's being very, very, very picky with a lot of these earnings prints over the course of this quarter, but definitely nothing wrong with the business overall. You can see that even though EBITDA forecast came in slightly lower, it's still 29.6% better than it was at the same time last year. Moving in, you can see the headline of the article. Uber reports 20% revenue growth, but issues soft profit guidance. That had to do with the adjusted EBITDA metrics that they gave for Q1 forward guidance. Moving on further into some highlights from the article right here. Net income for the quarter was 296. This is justifying the miss on profit margins this quarter and miss on EPS. Net income for the quarter was just a touch under 300 million, which included a $1.6 billion net pre-tax headwind from revaluations of our equity investments. Net income a year earlier was 6.88 billion. So unfortunately, Uber taking a markdown on some of their other bet segments, which did hinder EPS and net income for this quarter. Uber's weaker profits were also related to higher taxes and its moves to provide more affordable rides to customers in order to grow bookings and win new users. That's working. It's impacting profits, but as we saw from the former metrics, right? I mean, the growth in mobility, deliveries, and etc., and monthly active users and trips is definitely paying off, so they're doing something right. The company said it had 202 million monthly active platform users, which was up 18%, as we said. Moving on a bit further here. Here's what the CEO had to say about the entire autonomous vehicle narrative. AVs will unlock a multi-trillion-dollar opportunity, adding that autonomy fundamentally amplifies the strengths of our existing platform. For Uber, it's the network effects, guys. It's the amount of trips that they do overall, the amount of data that they have, right? It's very easy for them to partner with many autonomous vehicle platforms out there, and we're going to talk about that when we go through the company's earnings slides. In Atlanta, Austin, Texas, where Uber offered autonomous rides in 2025, the overall trip growth significantly accelerated even for human drivers. Now, I'm pretty sure nobody saw this one coming, right? With the addition of autonomous vehicles, even human drivers are getting more trips, which is staggering. The addition of AV supply to the market has grown the category overall, and they have the data to prove that. By the end of 2026, Uber expects to be facilitating AV trips in up to 15 cities globally, split between the US and other countries. And by 2029, we intend to be the largest facilitator of AV trips in the world. This is the network effect that Uber has, which is why you would be investing in the company, right? Forthcoming cities include Houston, Los Angeles, San Francisco, as well as London, Munich, Hong Kong, Zurich, and Madrid. The CEO cautioned that autonomous vehicles are likely to remain a very small portion of the rideshare category for many years to come, given technological, regulatory, and other hurdles to their broader adoption. And everybody knows that, right? Everybody knows that autonomous vehicles will become more and more popular, but that the transition towards more of them will take years and years, right? And we know that from Tesla. Uber is also focused on growing its Uber One program, their subscription service, with members tending to book more rides and buy more items through Uber after they subscribe. The company is investing in its advertising business as well. So very bullish commentary here all across the board and a justification for the miss on EPS and net income. Moving on, take a look here. Here's Uber's free cash flow, one of the big reasons to be an investor in the company. Very strong free cash flow metrics by the business over the course of the past 2 years. Very good. Moving on further, monthly active consumers consumers, as you can see, has never been a problem for them. They haven't really slipped up at all, continue to grow at a very decent pace in my humble opinion. And now for the good old earnings slides. This is where the action is to be had from this earnings report. So slide number 1. Autonomous vehicles likely to drive incremental category growth. And we're talking about overall category growth, the entire mobility trips year over year. You can see the stars are when they started the autonomous vehicle rides in various cities, referencing Atlanta and Austin right here. The entire category grew. Very curious, right? Moving on here a little bit down further, AVs on Uber are significantly busier and more reliable than previous deployments. Very strong move right there, also contributing to overall category growth. 30% higher here, AV trips per vehicle per day, very strong. And as a result, what's happening with AVs is that their utilization, right? Sometimes because, you know, they're just putting more cars on the road essentially. So you know how Uber works, you got surge pricing and things like that, right? So because you have some peak periods, here is where AVs come in to support those peak periods, and even in off times as well. AV trips are the dark blue shaded category down here, and total mobility trips, including humans, is up there. You can see that AVs are really helping to improve supply for ride sharing overall, right? So many times I assume that Uber's logic behind this as well is sometimes when you see surge pricing or the lack of availability of rides or the pricing is too expensive, you may choose to take another form of transit, right? But as you add more cars onto the network and possibly AVs as well, and they can support some of these surge peak periods in the network, well, as a result, people are just choosing to continue to do rideshare instead of going for maybe public transit or other forms of transportation, or maybe taking their own cars or things like that, right? Moving on further here, Uber operates in 8,000 plus US markets, covering 95% of the overall US population. Extremely strong right here, guys. This is the network effect of Uber, right? So to say that autonomous vehicles are going to replace Uber's business in the short or even medium term, I do believe is a large fallacy. I think it'll be not a question of one or the other. I think Uber will be able to use its network effects and leverage their partnerships to also become one of the largest AV facilitators in the world. And here you go. Here's another slide indicating that they intend to be the largest facilitator in the world by 2029. Live cities right now, as you can see, Abu Dhabi and a few cities in the US. They got Dubai, they got Riyadh, and the Kingdom of Saudi Arabia as well. Upcoming cities include the ones that we previously talked about, but take a look right here, guys. I mean, so many integrations across the board. You know, anything from AV Ride, which is a Nebius product, Baidu, Momenta, Neuro, NVIDIA, Pony AI, Wabi, Waymo, Wave, WeRide as well. So many direct partnerships with hardware platforms as well. So very strong partnerships from Uber overall. We will just quickly glance over the highlights because we mostly covered them. Monthly active consumer growth is very strong, but trips per monthly active consumer, this is a very closely watched metric here. Plus 3%. So not only are people taking more trips, but they're taking, not only are individual people joining the platform more, but those people are taking more trips individually. Very strong trip growth overall. Gross bookings, excessively strong as well. Revenue print as well. Adjusted EBITDA, which is a closely watched metric. 35% growth year over year. Very strong move to the upside there. Operating income, company also has very good operating leverage, right? As they scale their revenues, their expense profile stays largely the same or goes down, meaning that they will become more and more profitable over time a little bit. Here's your non-GAAP EPS, what it would have been if you strip those one-time elements that they were talking about, the tax event and the markdown of their stuff. So they would have had 71 cents in EPS, which still, in relation to the estimate, would have been a miss. The estimate was 79 cents roughly. So if you take non-GAAP EPS, it still would have been a miss. However, still, right? They did a very good quarter right there. And some of your segment highlights as well, right? We're not going to spend too much time on these, but just to show you gross bookings, revenue, EBITDA also growing. So as they scale, they're keeping their profit margins or expanding their profit margins, and especially in delivery, man. Delivery, very, very interesting expansion of EBITDA numbers as they grow their gross bookings and they grow their revenues as well. Very efficient business, right? That being said. So that's everything I had for you guys for Uber. No need to go over more than that. I think you guys kind of get the point. The fact that they have a very good relationship with a lot of AV manufacturers. And I truly don't believe that the narrative of one or the other, that AVs are are going to replace Uber's business overall. I don't think that's the case. I think that a lot of autonomous vehicle networks will leverage Uber's very large network effects, and everybody's going to win in that case, right? You, the consumer, is going to win, Uber's going to win as a business, and the AVs, broadly speaking, will get more and more exposure and more traction in cities across the world. That being said, all that is good, but what about the valuation, right? All that can be good. Uber can be a very solid business, but how's the valuation? Is it a buy down here? Well, long-term portfolio, I do still believe it is a buy. I have not been able to buy Uber this cheap in a very long time, and I am looking forward to nibbling on some shares here all the way through the lower 60s if they truly do want to send it down there, because at $75 per share right now, you're trading still relatively cheap, right? I did revise the EPS estimate a little bit to the downside, and as a result, right now, we are at a 23 forward price to earnings, very fair. You're at a 1.47 peg, also very fair, and a 5.35% free cash flow yield. I do believe here, categorically speaking, Uber is fairly attractive, which is why I will be increasing my amount of buys here in the 70s to mid 60s location. I've been a holder in this stock since shortly after the IPO, and it's been a very good hold for me, but if they continue to give me more and more attractive pricing as the business keeps growing, I definitely will take it. I mean, the forward growth profile for Uber is very strong, guys. Revenue growth of about 13% per year on average for the next few years, and EPS growth being very solid too, and increasing their margins. I mean, EPS steadily increasing the next few years, and revenue steadily increasing as well. So very nice implementation of autonomous vehicles in their networks, very nice network effects, and just an overall beautiful product. So those are my thoughts on Uber. I will indeed be a buyer, but if you don't agree with the thesis, if you think that AVs are going to cannibalize Uber's entire business, maybe this one is not for you, and that is perfectly fine. This is not meant to be advising you guys to buy Uber, just for those people that are interested, just to let you know whether or not the thesis is still alive and the pros and cons that the business is facing right now. So that's everything I had for you guys for our earnings presentations. Hopefully you enjoyed. Now, let's move into some charts. And this video will be a long one because I did a big introduction, and I'll only do those big introductions. I know I say there's always an exception, but let's be honest, right? The past month, the market has been confusing for most people, right? Which is why I've made so many videos on the rotations, the themes, the things to watch out for in 2026. That's why I've made such long videos, right? If I didn't want to give you guys any context and just sit here with my arms crossed and just give you support resistance levels, I can make these videos super short. But I think you guys appreciate the in-depth analysis, so we will continue in doing so. That being said, let's move into the indexes and some of the price action structure. All right, so moving into the SPY right now, guys, down 0.5%, but we're not really losing structure. It would be much different, of course, if all of the major sectors were dropping at the same time, but that's not the case. And you can also derive that it's not really a move to safety trade. It's a big rotation trade, but not necessarily for safety reasons overall. If not, you would see a net increase in bond exposure, but that's just not happening, right? Additionally, as well, if it was a move to safety, well, you would have seen investors after getting flushed out of gold and silver, right? You would see them right back at their highs, but that's not happening. So there is a clear deleveraging in the market going on right now, to where certain popular retail names and certain popular retail sectors are being deleveraged in favor of, quite frankly, very boring names that not many people do end up playing, right? I'm pretty sure not many of you have unless you're at that stage in your trading career or investing career, or you're close to retirement, right? Pretty sure not many people have a massive dividend portfolio full of consumer staple stocks, right? Nor do people have a massive portfolio full of utilities or perhaps some industrial names, or largely finance-based as well, or insurance players too. And those all did very well today, right? Or even oil companies. So big deleveraging event, and the SPY, as a result, is holding up fairly well, all things considered, right? I mean, individual names are down an absolute ton. We'll talk about that at the end of the video, but the S&P itself is actually holding structure fairly well, right? We're still hunting for a daily higher low, still holding support. Now that may not last forever. If they kill the entire rest of the market, that is when the S&P is really going to fall off a cliff. But as of right now, no major red flags, at least on the SPY. In technology, there's a few, but not in the SPY. Support stays put, 686 to 679. We've now tested this one a few times, and the bulls have been able to defend it just because of how broad the market has been. So we still do have a bullish leaning bias on the S&P. I know, but the S&P doesn't look too bad. It's just been consolidating now for a while. The weekly timeframes are not lost. You got to pay attention to 676. If you flush that, that is your true line in the sand, daily high or low. And then if that happens, then we can talk about the weekly downtrend rollover and possibly the ability for the bears to capitalize and go for the ever infamous test of the 12-month EMA, which is usually the moment in time where the bulls start buying the dip more aggressively, and it can just be a nice retest of structure, something that's happened many, many times over the course of the S&P's history. It's just normal price action at that point, right? Moving on to the QQQs. The QQQs, few key little red flags right here. So we were noticing this tightening range right here, and they tried to go for the breakout, but then last week, man, they brought in the volatility and they unwound everything. Thursday was a very weird day. You might remember I made a video. It was a very weird day. That day, the VIX expanded, but there was no news. It was just basically price action driven and was kind of the initial onslaught of some of the tech names getting a little bit wobbly, right? And then that continued into Friday. Friday, these silver and gold liquidations really started cascading into different elements of the market to where, once again, a lot of the tech names ended up red. Monday was a little bit of a green day for most of the market. We talked about on the channel. It was a bit of a recovery day, but then yesterday was software, which poured into everything else tech, and then today, which was basically semiconductors and still almost everything else tech, and then small caps and mid caps, just unwinding the price action altogether. So you do have a big engulfing move now to the downside. They did break your line in the sand structure. They also came below the support area, but did not lose it. They tested the lows of the 17th of December, I'll remind you. And as a result, guys, losing structure right here, you would not be surprised. You could take a look at the futures market right now, yeah? You would not be surprised if this does continue into a lower bound range right here, under 600, talking about 597 to 589. The lows, some of the lows of the post-October sell-off on technology, and also some of the lows from the China narrative after that tariff announcement day, October the 10th. So please keep that in mind. And you know what's not too far away from there? This whole region right here, 584. So the bears can do something right now on the Qs, right? They can go for the 12-month EMA backtest, which top to bottom would be from the top of, let's say, late October to where we are right now, almost a 9-10% correction. Do they have the juice to get down there? You would argue no, because nothing is fundamentally broken in the markets right now. It's a big deleveraging event, right? However, nothing is fundamentally broken with any of these companies. As a matter of fact, as an investor in many of these companies that reported earnings recently, such as AMD, such as Google, right, such as Meta, such as Microsoft, such as even companies that are coming down today, like NVIDIA, companies like SOFI, right? I still have a few Palantir shares as well, more than a few. All these companies reported very solid numbers. So despite the fact that the price action is garbage right now for a lot of these companies, we can't be bearish on the earnings. The earnings were fantastic. Revenues are good, guidance is good, and that is the case for most of tech. Now, there's a few little exceptions here and there, but for the most part, the companies we talk about on a daily basis, they're posting very, very strong earnings. So do they have a fundamental reason to come down here? No. But have they generated a nice little fear-driven sell-off narrative that a lot of people are believing, and that could, you know, big selling can beget more selling. We can actually come down here, test the 200, and go for the full monthly 12 EMA retrace? You absolutely can. They have the narrative. They don't have the fundamentals to do it, but you have the sentiment, you have the momentum now to the downside, and you have the narrative. It's a very funny narrative, especially if you just think for 2 seconds about what's going on, right? Software companies are being destroyed by AI, but then the very same companies that are building said AI, right? Everything's going down. So like, can it really be both at the same time? Like the company that's giving, the two companies for the most part, well, we can even include Broadcom in these, right? So the two companies, AMD, NVIDIA, and number 3 would be Broadcom, the 3 companies that are enabling either the hyperscalers or other corporations to actually build these models that are supposedly crushing AI. And we can see renewed CapEx investments from Google today, Meta last week, Microsoft last week as well. And pay attention, I mean, you'll hear from it from Amazon tomorrow as well, right? All these companies spending so much money for AI, so much money getting put into chips, right? So what's going to happen? How can the chip names and the hyperscalers that are building AI that's going to disrupt SaaS, how can they be going down, but then also SaaS companies are going down, right? It just doesn't make sense, which is why I think it's a manufactured sell-off, liquidation flushes, margin flushes for a lot of very popular trades, which is leading a lot of people to be somewhat confused right now. And I completely get it. Just because we can understand what's happening right now doesn't necessarily mean that we can stop the declines. Yes, the declines are ridiculous. Yes, it's sentiment driven, but you guys know the rules, right? If you disagree with the reasons behind the sell-off, well, then you should be a dip buyer. You can be a dip buyer slowly, but you should indeed be a dip buyer because none of the fundamentals on these companies changed at all. Nothing changed with SOFI, nothing changed with Uber today, nothing changed with Palantir, nothing changed with many companies that have been dropping recently, nothing changed with NVIDIA. What's changed with NVIDIA from 4 days ago for them to be down 11% right now? Absolutely nothing, right? What's changed on Microsoft? Absolutely nothing. Some people could argue the remaining performance obligations from OpenAI, but we dispelled that when we talked about their earnings last week, saying like, listen, compute is a commodity, right? If they have so many obligations here from OpenAI, they're supply constrained, just like Google is. If OpenAI isn't good for all of that compute and they only take half, you don't think that Microsoft's going to find other clients that will gladly take that compute? They've been saying for 4 quarters now that they're supply constrained. They can't even give the compute to all the clients that they want to. So if OpenAI goes back on the deal, Microsoft will be able to refill that pipeline without a shadow of a doubt. So it's like, you know, all these little mini narratives right here, yes, they don't make sense, but it doesn't mean that just because we find that they don't make sense, it's not going to solve the issues that the market wants things lower right now for XYZ reason. You may not agree with the reasons, but it is what it is. It's your job as a trader and an investor to see through the noise, right? If you can see through the noise and see the companies are still doing fundamentally well, you would be a dip buyer down here. You'd be doing so slowly, and you kind of want to avoid short-term call options and things of that nature, right? But especially for long-term portfolio investors out there, you would indeed be a dip buyer for some of these quote-unquote, well, I'm not quoting anybody, some of these, dare I say, ridiculous declines, right? So please keep that in mind when you're thinking about the QQQs and thinking about everything that's happening in the markets today. Sorry, I'm just checking my OBS just to make sure the screen is still moving. Moving on to XLF financials right now. Financials up 0.8%. I mean, the banks have been one of the places to be, right? We talked about this little rotation back into the banks after their earnings sell-off. I mean, even the banks, right? They had great earnings and they sold them off. Right? We talked about it too. Where did they sell them off into? The exact buy zone that we were looking for, right? So JP Morgan was a good pickup down here. Bank of America could have been a good pickup down there as well. They didn't give quite as close of a touch to the area I was looking for, but JP Morgan was my top pick. MasterCard, phenomenal buy down here in the low 500s. Visa, phenomenal buy down here in the low 300s as well. So there's many names in financials that are just super easy buys in my opinion, regardless of the current narratives against them. SPGI is such an easy buy in my opinion. Moody's Corporation, such an easy buy as well. So that being said, I mean, look, Moody's, right? They just dropped it over the past month, even though nothing's changed with the business. It's down 17%. You know what I mean? On Moody's of all companies. So that being said, financials not looking bad. Weekly timeframes are still in bullish control. Just looking for a bit of re-expansion potentially and looking for the monthly continuation leg as well after a bit of consolidation. You would not be surprised if financials have a very good year. I mean, all their earnings were fantastic, let's be honest. Healthcare, 1.25% to the upside. Eli Lilly absolutely crushed earnings. They were up 10.5%. I know we don't cover Eli Lilly on the channel, but they absolutely destroyed it, man. Absolutely destroyed it. 9% beat on earnings, 7.5% beat on revenue. Such a solid company. And many people were asking me when Eli Lilly was selling off at the midpoint of last year, whether or not I would buy Eli Lilly on a, you know, call it 15, 20% drop down here, or NVO on a like 70% drop. And I kept saying Eli Lilly every single time because they have the broader pipeline for drugs and they just have better, a better business. I'm just going to be completely honest with you, right? I would take Eli Lilly every single time, and Eli Lilly has been a tremendous performer. It's trading very rich out here, so I wouldn't necessarily be buying up here, but once again, lifting the overall healthcare category. Still, though, trapped in some form of a consolidating, tightening range right now, so we're looking for a break above either 158 for any further longs, or a breakdown and retest down here for 148 for any further longs as well, right? I want confirmation. So you either got to give me the breakout retest as a confirmation, or if I'm looking for quick and rapid trades, you got to give me the break and close above 158, 159 to show me that, all right, we're done with this consolidation range and we're ready for another leg of expansion, possibly another 5-10% to the upside. So I'd be watching for a break and close above, similar to what XLE did, right? Where we were kind of coiling up in this area, and then we were talking about there being some nice opportunities right here to go for the breakout of that range. That was already into an area, right? XLV is kind of like, we're not in an area right now. You're consolidating up here. So you're going to want a breakout of that range to further position long, or a breakdown, because positioning in a range like this is somewhat dubious. Moving into SMH right now. So SMH down 4%, but I mean, take a look what happened here, right? Well, not only, I mean, you take a look at the heat map, right? NVIDIA, Broadcom, Micron down 9, AMD down 17, SanDisk, right? Everybody's new favorite company right now. Western Digital down as well, you know, and other things of that nature. So a lot of the semiconductors coming down. LRCX, right, down huge, breaking structure to the downside on the daily. Clear attempt for a weekly higher low right now on a lot of these names. And we were talking about this, right? ASML also ran super rich. We were talking about, like, I'm not a big fan of chasing those without a big pullback. So maybe this pullback is something that everybody's been waiting for. We'll see how long it lasts, but you clearly saw it on the SMH. Right? SMH, we were saying the price action was getting really tight at the top here. And after yesterday's action, we were saying if they keep going lower, we're going for the weekly higher low. And that's exactly what we're doing right now. Weekly higher lows are set right now at 338. So we will see if their bulls are able to stop this around this weekly 12 EMA and the previous resistance, which is current support. If they're not able to stop it and we go lower, something like this, well, that's going to be your monthly consolidation, right? And it hasn't done it for the past 2 months, but that would be notable to me overall. So pay attention to that rotation down potentially from semiconductors, not because they didn't have good earnings. No, it's because they all ran super hot. Oh, except for certain names. I mean, there's certain names that have been down for a while now, such as Broadcom and such as NVIDIA, but those are buys. But a lot of the names that ran super hot, if you guys are looking to maybe acquire positions in here to play the momentum, we'll just watch for the declines, right? We know nothing's wrong with their business models, but eventually, man, like, nothing goes up in an absolute straight line, even if they are fundamentally cheap, so to speak, right? So keep that in mind. Moving on lastly into the Russell right now. So the Russell actually holding up not too poorly. You can clearly tell, right? Yes, we lost the daily uptrend. And yes, they tried to go for the daily downtrend flush today. However, didn't get it done. And in the grand scheme of things, we're just looking for a weekly higher low. This chart, in my opinion, looks great. Maybe the last few weeks we've been consolidating. This is true, but it looks great. 255 down to 250 is the backtest location if you're looking for it. On the monthly chart, still looks great in terms of overall expansion. Hasn't pulled back nearly as much as the Qs, and a lot of these smaller cap or mid cap growth names have been doing very well since the start of the year, depending on which theme you're playing, right? Robotics, the space trade was popular, military trade was very popular, energy was very popular as well. Not all aspects of small cap growth stocks are doing well, but many aspects, if you were paying attention to the key themes of 2026, have been doing really well. And obviously over the past few weeks, we've been talking about the excess returns in consumer staples, real estate, energy as well. And I do think that this rotation is well underway into those sectors too. So please keep that in mind. The VIX is currently standing right now at about 18. But you know what's funny? Usually you get a VIX trigger from a macro catalyst event, or you know, the administration doing something big in terms of something with tariffs or anything like that. Or we get a bad jobs report, which, by the way, today the jobs report wasn't bad. I forgot to mention it, 22,000 versus 48K. I mean, it's a lower print, but this is good for rate cuts, right? So it's kind of like another situation where bad news is good news, because the bad news is not bad enough to warrant any true worry, but it is bad enough to warrant further interest rate cuts to protect the labor market. You know what I mean? It's kind of that whole situation again. So what we've seen, I mean, this was the Greenland situation, right? That's macro. This, what we've seen the last 4 days, that's not macro, right? Which is why it's kind of funny. All of these previous situations, by the way, were also macro related. Other than this one was the big tech sell-off flush with the OpenAI news and stuff like that. This was the China tariffs. Most of your VIX spikes are macro news related, or when some big piece of news crushes an entire industry, like when DeepSeek happened like about a year ago at this point in time. And people panicked and said, like, oh no, that's the end of all the models the US has been building. Something big like that. In the past 4 days, we've had literally nothing. Not much in terms of a news cycle to warrant an increase in volatility like that, but people are currently seeking protection. By the way, fear and greed index right now is, you know what's funny? Is back in a fear, right? Even though nothing really happened, it's back in fear because the fear and greed index is driven by a lot of momentum indicators and some relative stock price strength indicators, right? Extreme fear, people are buying more put options right now, you know, and volatility metrics and things like that. But especially this one right here, which has the highest weight in this reading right here, the market momentum has just been fading and fading. So we're now back into a fear environment. But without any actual big fear catalyst drivers. We've described all the possible drivers, and not many of them are that serious in my opinion, but just because I don't feel they're that serious doesn't mean the market's not just going to keep dropping and keep flushing out the leverage, keep flushing out the margin, right? Speaking about gold and silver, let's take a look at gold and silver and some of our other assets. Gold and silver, I mean, they had an okay day on Wednesday. Now in the overnight session, right, they've kind of retraced a little bit more. So as we've been saying, right, gold kind of gave back all of its move. And there's only two things that could possibly, two probable scenarios, and one of which is not a full V shape, right? Either you have to do a two-stage daily uptrend recovery, right? But the full V shape of a massive engulfing move like this is the unlikely scenario. So you may as well just rule it out, right? Because it happens so few times. That being said, few possible situations. Either the bulls are able to recapture the trend like this, or best case scenario for the bulls, in my opinion, would just be a tightening up of the range. Why do I say best case scenario? Because you still got to cool off some of these time frames, right? You got to cool off the RSI on the weekly a little bit. You got to cool off the monthly RSI a little bit too. It's still up here at about 94. So the bulls haven't lost any major time frames. The weekly higher lows are still protected, but the daily might just be choppy here for a while. So keep that in mind. No positions for me on gold right now. I would rather them establish some form of a trading range to establish a local bottom, because the last thing that I want is to just get unwound here, daily downtrend continuation, and just further weekly consolidation, which will just be looking for a monthly higher low attempt, possibly to the 12 EMA down there. I mean, gold's done it many times, just hasn't done it in a while, right? So little declines here into a key moving average would not be surprising in my opinion, but no positions from me. Moving on to the silver trade overall too. So silver had an okay day on Wednesday, was up 3.36%. Let me just move myself over. Oh, never mind, I'm already over, never mind. Silver had an okay day yesterday, but as I said, right, look at the size of the bounce on gold. Okay, that's like a 50% retracement bounce. And then look at the size of the bounce on silver. Only like 30%. That's fairly soft. When you get such a soft bounce, guys, there is an opportunity for the bears to roll over and flush this a little bit more, right? Best case scenario for the bulls right now is you give me a higher low and go for a new daily uptrend and start clawing back some of that weekly candle that you printed last week. But now, with a full weekly unwind, it's looking more and more like the best chance that silver has is just to form some form of a tightening range in this whole, let's call it between $70 and $90, $95 area, right? Just tighten up this very wide range, right? But right now we're seeing further liquidations, in my opinion. Silver's down 12% in the overnight session. So, when commodities start moving like, small cap stocks, you know that there's probably a very crowded trade with good reason. We've talked about the reasons many times, right? There are very valid points for silver being a very popular trade. But as we were saying, right, it's never the best to go for an exponential parabolic move and buy the top at 120. So if you guys are still fundamentally bullish on silver and you want it to position, well, maybe now is your dip opportunity. For me personally, I'd rather wait until the price action clears up a little bit. So we'll see what happens there. Moving on to Bitcoin. Bitcoin and Ethereum just continue to be an absolute disaster, right? They're going for the absolute full retracement of the 200 weekly EMA. That doesn't get tested often. Last time was in, the end of the bear market back there in 2023. So we've now fully unwound even more. You've lost all the time frames. It's sad to say, right? Daily is just a screaming daily downtrend. No buyers right there. Daily oversold conditions. The weekly, this was a weekly bear flag. Further flush, you've unwound that, going into the last area of support. There's more, but this is a pretty big one. 66 down about 74. You really come into that one fast. And now, sadly, guys, we've unwound the monthly time frame. This is what I didn't want to see. You've unwound the monthly time frame. So that doesn't mean that you're going into a massive crypto winter like this. It could be, but it just means that in the event this is indeed the bottom, the V shape is going to be highly unlikely. It will take them a very long time to rebuild this monthly price action structure, which is why I say there's no short-term opportunities on Bitcoin right now. Only long-term buyers can make sense of this chart. Moving on to Ethereum is the exact same concept, right? Daily downtrend all day. Weekly, this was a bear flag, as we were talking about, right? Failed breakout after failed breakout after failed weekly trend change. Ended up in a bear flag, and now you've unwound everything. You're at the last area of support, in my opinion, which is 2100. Area below that is 1750 down to about 1300. I know, crazy to say, right? And on the monthly time frame as well, you've now unwound absolutely almost the entire move. Usually when you get a 70% retracement like this, the V shape is incredibly difficult to do. So same concept as Bitcoin. Even if this is to be the bottom, it's going to take a long time to reset the monthly upcycle, in my humble opinion. So crypto is not something that I'm trading specifically right now. right? The only thing I would be doing if I were interested in Bitcoin or Ethereum would be just nibbling very slowly for long-term acquisitions that I'm planning to hold for the next 2, 3, 4, 5 years. But as of right now, no short-term swing trades on me for either of these two assets right there, right? So now that's everything for the overall market. Now let's move into our big tech names. And I hope I get some time to do the biggest gainers and losers of the day today. We spent a lot of time on the introduction, a lot of time explaining what's happening, right? Rather than going through, it depends what you guys want, right? If you guys just want me to go through all these charts, then I won't be able to give you guys so much context as to why everything's happening, right? But if you guys want more context, then I have to take away some time from the end of the video from the charts. So, but there's also earnings. I did spend like 20 something minutes on Uber and Google. So anyways, moving on further here, talking about first off, good old Apple. Apple, the only company who hasn't spent hundreds of billions of dollars in CapEx, well, continues to be a very popular trade. Apple's now, I guess, no longer in the tech segment. It's now in the value and defensive segment, right? It kind of makes sense. At the same time, though, Apple did have very stellar earnings, which you covered on the channel. So looking to break above 275 to 266 area of resistance. Apple was indeed a buy for me down here, and I was very clear on that. But right now, you kind of have to set the brakes on Apple. Looking very good, though. Weekly, they're recapturing this entire move, and if you don't know why, it's the higher time frames coming into play, right? Apple, very strong bounce here off the 12 EMA, which was consequently also previous all-time high resistance, which is now consequently high support level, right? That being said, looking very good for the continuation. I'd be kind of hesitant for net new Apple longs up here. There was a time to do it, and now unfortunately it's a time to pause. That being said, Apple very strong, and I'm holding all of my shares. I'm just not necessarily adding anymore, but Apple should have a very good year. They give us great earnings, great guidance. Moving on to AMD right now. AMD down 17.31% today. Once again, challenging $200 psychological. Now, the bears have a lot of momentum this time. Not that they didn't this time or this time as well, right? But this time after earnings, they got a lot of momentum. Let's just say it that way, right? So the next target, if we break 200 psychological, because let's be honest, other than these three gentlemen right here, there's not much, yeah? So down here, 190 to about 175 is the next support range. That's a more clear area. It was resistance a few times in the past, 2024, and a few times in 2025 as well. There is that previous earnings gap to be filled all the way down there, 165. I mean, I would be hard-pressed to believe that they can fill this entire gap, but I guess maybe crazier things have happened. But I do enjoy AMD, and we said it yesterday after earnings. I enjoy AMD below 220, and now we're definitely below 220. This 200 down to like maybe 180 pocket is, in my opinion, a phenomenal opportunity to be picking up this company. If you don't know why, you can go watch my earnings segment on them yesterday. The company is very cheap. Thesis is still very much intact for this business, and we're trading under a 1 peg right now at 222. So you can imagine 10% lower than this, the valuations are looking extremely compelling for this power player in the data center build out phase. And I mean, guys, Google just raised their capex to $180 billion, right? There's just so much money that'll come into these chips, NVIDIA, AMD, and consequently the TPUs, which for the most part Broadcom is building as well. But look at Broadcom, right? Broadcom's down 4%, and even after the Google earnings, right, they came up nice, in a very nice fashion. So, eventually people realize that AMD cards and NVIDIA cards will also be used by a lot of the hyperscalers and other data center players, and they'll get bid up as well. But this was a nice bounce for Broadcom because Google is one of their very large customers for their own TPUs. Speaking about Amazon right now, Amazon down 2.36%. Amazon has earnings tomorrow, so tough to say what Amazon's going to do, but if Google, Microsoft, and all the other ones are any indication, if there's anything that the market can pick apart from this earnings report, they will send Amazon down, and we will cover it after the channel, but you guys know the drill, right? Amazon under 220 is a screaming buy for me. If they pop off after earnings, well, that means that they absolutely crush it, and the market just couldn't find anything wrong with their earnings. That being said, guys, cloud growth, right? AWS cloud growth is going to be the biggest thing to pay attention to tomorrow for Amazon, but their e-commerce business should do really well. It is a Q4 earnings print. So their e-commerce business, Christmas, and things like that will be included in there too. Advertising should do quite well as well, but it'll all be focused on the AWS number. If they miss the mark by a few percentage points, they might send them down like Microsoft. If they beat the mark by a few percentage points, well, just like Google, they may just end up flat. Kind of odd how that works, right? But Amazon, one of my favorite bets in the market right now, it's been coiling up for a long time, so we'll have a look at what they say tomorrow after earnings. Moving on to Google right now. So Google, we already covered them, but just to kind of reiterate where we stand, line in the sand right now for Google bulls is going to be 320. If you lose 320, you're going to lose the daily uptrend, and you will be going into weekly consolidation, right? The only problem for Google right now is that they're so extended, and we really didn't bother setting much in terms of support on the way up. Like at all. I guess you could kind of argue that there's maybe one section right here, 310 out of 300, but it's not very solid, right? If they choose to go for a larger retracement, you guys now understand why. It's just because the technicals and the price action is a bit extended and the valuation is a bit extended as well, but phenomenal company. It's just a hold for me. I'm not necessarily adding anything new up here on Google. Meta, unfortunately, guys, giving back the entire earnings move, all of it. Right? So there was a big gap. They filled the gap. They also lost the support range, 705 down to about 677, let's call it 680. They flushed below that again, and now once again challenging our 200-day EMA. Next support for Meta, if the bulls just can't keep it up, we're coming right back down here, 640, 630. But now that we have better earnings visibility, right, this should be a screaming buy in my opinion. At 715, it was already a buy, but you guys know the valuation. At 640, just take 10% off of this, right? You're going to be once again trading at a 21 forward P, 20 forward P. It's going to be closer to 1.5 peg again, and Meta will once again become one of the best buys in the market. Not that at 700 it wasn't, but at 640, 630, it just gets super compelling. So unfortunate sell-off for Meta. It's just been affected by the rest of the market right now, but I will once again be adding Meta shares. I was getting nervous, man, that they might just run away and not let me add any more shares. But if they want me to add more shares, I definitely will be doing it down in this pocket. I mean, it's already a good price here, you know, but best, 640, 630 and lower. Moving on to Microsoft right now. Microsoft up 0.72%. I know, up on a day like today, right? Maybe all the sell up, maybe everybody that wanted to sell is now out of Microsoft. But, you know, top here to the bottom of post earnings, 15%. I don't believe that they deserved a 15% sell-off, but then, hey, who am I, right? I don't control the multi-billion-dollar algorithms that, you know, lead to a lot of this momentum selling sometimes and just force liquidations. That being said, Microsoft is currently off its all-time highs by a whopping 25% in around 410. The forward price earnings at a 25. It's a 1.4 peg into years worth of support. Talking about 410, down about 390. Crazy area. So selling some put options down here, big fan. Buying some shares down here, big fan. And I will be picking up another leap call options on Microsoft as well. I think this sell-off is way too overdone. Moving on to Netflix right now. Netflix actually green, but have they changed anything? No. Pay attention, 12 daily EMA. If we cannot claim this 12 EMA and reset the uptrend, we cannot say that the weekly leg of selling is done or that the monthly phase of selling is done either. My next price target for Netflix right now remains at the $75 200 weekly EMA. It is weekly oversold conditions. It is daily oversold conditions. Monthly, not quite, but it's really cool off a lot. Company is giving good value down here under 83. So Netflix is still a buy for me, but we know it will be very noisy until the good old Warner Brothers deal concludes in the month of March. Moving on further here to NVIDIA, a couple more that we have to do. NVIDIA down 3.41%. Gosh knows why. They just got caught up in the rest of the sell-off, I guess. Down here, 170 down to about 165. We are back into my best price range for NVIDIA. This green line is the 200-day EMA. It's been support for a better part of the last few months as well, talking about the last 5-6 months, and it's just been nice monthly accumulation, right? There's been some ups, there's been some downs, but by large and by far, NVIDIA has held these price levels. And I don't know how you can be bearish on NVIDIA, right? When you have so much CapEx spent, so much CapEx renewal, right? From Meta, Microsoft, now Google, you'll hear it from Amazon tomorrow as well. The guidance on NVIDIA for this quarter and for the year should be absolutely phenomenal, but we already know that, right? That being said, at 175, it's finally at my 175 area, right? Low forward price to earnings ratio, it's a 1 peg. I don't think NVIDIA should be trading at a 1 peg right now, but hey, I don't make the rules, right? Revenue growth and EPS growth rates are still very solid. So NVIDIA does remain a buy for me, categorical buy down here. Moving on to Tesla right now. Tesla coming back into the range that we've been talking about, right? This whole 406 down to roughly 380. I don't know why my boxes are not on the Tesla chart right now. Did something just happen? Tesla, there you go. So Tesla down 4% today, 406 down to 382. If you're looking to accumulate some Tesla longs, we've been talking about this for a while, right? This whole monthly retracement phase for the stock, maybe down into the 12 EMA, 386 would be the bottom end of that. I would be accumulating slowly because just keep in mind, Tesla is overvalued, and we know that overvalued companies in this market recently have been getting absolutely killed. Just look at Palantir. That being said, if you are buying Tesla right now, you're buying for the long-term thesis. So if you're buying, you got to have like a 3, 4, 5, 6 year time horizon for the ramp of Optimus, the ramp of FSD, the robo-taxis, the energy business, the data centers in space, and everything in between, right? Moving on to Palantir right now. Palantir down. I don't know why Palantir was down 12% today, but I guess it is what it is, right? They had great earnings. Nevertheless, from the top of earnings, down 17%. We almost lost well, we did technically lose this 140 area, closing at 139.54. It wasn't a very strong area. It was never a very strong area, but it was the closest one that we had. I've mentioned that a few times. In the event that Palantir bulls are not able to stop the bleeding right here, I mean, this is the first time that Palantir is traded under the 200-day EMA in a very long time, guys. In a very long time. And I'm talking about since back here before the rally even started. This is the first time that Palantir has closed a daily candle below the 200-day EMA, right? Well, it's not the first time. There was a few times prior, but then they had the earnings, and we were hoping that that would be the end of it. But there you go, man. So this time is definitely different. You got to pay attention to that, right? The next stop for Palantir, if they keep the bleeding going, is down here, 127 roughly to about 117. Keep that in mind. We covered their earnings the other day. If you didn't see them, definitely go watch the video that I posted just the other day. And if you do come down there, guys, you're going to test the 26 EMA. They haven't tested the 26-month EMA since, I don't know, since the rally started here at about 15. So things have notably changed, right? I mean, you can say that Palantir is overvalued, but it is a unicorn company. But Palantir's been coming down recently, man. Not only is it high beta, high growth, it has a very high valuation. And you know what's funny? It's considered packaged software, as you can see for the title right here. So just getting sold down indiscriminately, even though Palantir is a product that you can argue can replace a lot of software companies out there because it's pure play AI. Doesn't matter, man. It has software in the name, so I guess you must have to sell it off anyways, right? But the valuation has been expensive, so you can argue that maybe that's, translating to the sell-off as well. Moving on to SOFI right now. SOFI cracking below 21, man. And they're really starting to run out of support guys right here, right? So 21 out of 20 is like your last stand, right? The very last stand for SOFI bulls. They're daily oversold condition, so the stock should be a buy right now. They had their earnings the other day. We covered them at 22. It's a 1.1 peg. It's a 6 forward price to sales. Guidance was a little bit light, but there was really nothing bad about that earnings report overall. Covered it on the channel. Next stop, if you go a little bit lower, guys, I hate to say it, but it's 18.17. That's just where the chart says that we're going, because we never bothered to set anything here in the whole 19 under, between $20 and $18. There's not much there, right? There's just a big level from 25 to low 20s, and then another huge level from about 17 down to 14. That's just what the chart says. Now, that being said, if I'm a long-term investor, am I accumulating more SOFI shares here? Yeah, it indeed is a buying opportunity, but just keep in mind, right? The bears control the short-term time frames. They control the daily downtrend. They control the weekly downtrend. You could argue, well, it's so oversold, the bounce is coming. Perhaps, but it doesn't mean that they can't just do this, right? So I'm not willing to call this the absolute bottom on SOFI. I will say it's a nice buying opportunity if you're a long-term investor, but also we need to be patient enough to have some money to DCA it down there and not be disillusioned to the fact that it can indeed come down there. I mean, look at the momentum, right? Moving on to Uber right now. We covered Uber for their earnings, but just to reiterate, if we lose this area here, guys, right, this whole 72, the only next logical location that we could possibly come down to is below the 200 weekly EMA, which would be roughly mid-60s to about mid-50s. That's the next big area. It's the previous lows from 2024. It's the previous highs from 2021. So that is the key area of structure support. And it can be done, right? We can literally forfeit this entire monthly move. Crazier things have happened. Just look what's happening in the market overall. It doesn't mean it's not going to be a buy. It would mean that it's a screaming buy on Uber to pick it up when it was, back here, this is like a year ago, right? Almost 2 years at this point. Okay. And they've only done nothing but improve earnings and improve earnings and improve earnings. So when you find a company that's improved earnings a lot more than back here, and it's the same stock price, it means the valuation's been getting cheaper and cheaper, which indeed is the case. So Uber remains a buy for me on the long term. And also selling puts down here, not a bad opportunity to capitalize on some of these declines as well. And lastly, good old Taiwan Semiconductor. Taiwan Semiconductor down 3% on the day. That being said, the line in the sand level has been breached, 327. So you're watching this one for the breakdown. You got the breakdown, daily downtrend, unfortunately, and as a result, weekly consolidation. Maybe coming into 310 out of 300, but even this one, man, the monthly time frame holds the key. It's super extended, right? So maybe just semiconductors, broadly speaking, have to have one more leg further. 310 to 300 is the area we're watching on TSM, looking for a weekly higher low, and hopefully they stop it there because you don't want the full monthly retracement on TSM, man. That would bring you all the way back down to roughly 275, 280, which would be a phenomenal buying opportunity. But as of right now, I'm not really playing TSM. I'm not buying TSM up here. If you give me a discount though, under 300, I may just consider it once again. But up here, I mean, the valuation is pretty good. 340, 330. It's not that it's not good. It's just I look for a good valuation with a good technical entry at the same time, right? If it only has one of the two, I'll take something else that has a great valuation and great technical entry, right? So TSM is a hold for me. It's not a buy up here. It's a hold. It's definitely not a sell because their business is firing on all cylinders. We heard from that when they gave their earnings January 16th. And that being said, that's everything I had for you guys for overall market rundown, the news catalysts, the earnings. Hopefully you guys enjoyed. Now let's spend like 5 minutes. I don't know how long this video is, but I'll probably spend like 5-7 minutes taking a look at this biggest gainers and losers and talk about a few more of the declines, what's happening here, and where I might want to buy. All right, let's run through a few of these, shall we? So let's start off with IRN. IRN has IRN has earnings tomorrow. IRN, as I've been saying, is a buy from me, 40 down to 30 bucks. If they do come down there after earnings, it would definitely be more of an addition for my portfolio, specifically as we be coming very close to the infamous 12 EMA. Their backlog is massive. The amount of power they're bringing on is massive. If they drop tomorrow after earnings, it might just have to do with the construction timelines, right? That's what affected CoreWeave after their most recent earnings. And we know that a lot of this stuff, guys, is in the execution and building phase of the market, right? This is the phase of the market where we got all the deals for AI and the cloud providers, right? Now we're in the execution layer. And at the end of this year into 2027, that's when the data centers are not mostly, but a lot of them are being built and generating true revenues. So keep that in mind when looking at this one. And while we're on the Oracle chart, is Oracle a buy for me? I just can't get around the debt, man. I just can't do it. So Oracle would probably be my least. I would honestly buy IRN and NBIS over Oracle right now, but that's just me personally. We already talked about AMD. No need to talk about it anymore. Moving on to maybe SanDisk, right? SanDisk got to be a little bit cautious with these memory names. Yes, they're cheap. You can make an argument they're undervalued. You can make an argument that they're not so cyclical, at least for the next 2-3 years, as there's a massive memory shortage. Prices of memory are going through the roof. Everybody knows that, right? But we can't just buy things anywhere on the chart, especially after parabolic moves, right? It may look amazing, amazing, amazing. It gets you a whole bunch. It gets you a lot of people into FOMO, right? And then they just kind of revert. And it doesn't mean that even here, you know what I mean? They can consolidate. It doesn't need to go up in a straight line. So SanDisk, if I'm looking for SanDisk personally, it may never get there, and I'm fine with that. But if we can at least get a 12 EMA touch, and the 12 EMA will curl up, right? But if I can at least maybe find it in like the mid 4s, maybe you might see me playing this one. And the same can be said about Micron, right? Micron's not too far away from it. Micron low 3s, you may find me playing Micron, but it's just that I will not chase these parabolic moves at the top end of RSIs, right? It just doesn't make sense to me when I look at the weekly time frame and it looks like this. I mean, the monthlies are just gone. They may never touch the 12 EMA, for the next, month or so, right? But if I'm looking for first entries for a bit of a swing trade long, it would probably be down there on some of these memory names overall. I mean, you could talk about the valuation. You can argue that they're buys at any point in time, but just for technical purposes, 12 weekly EMAs, I may not mind either, right? Moving on to further themes, T Energy. I mean, if you like solar, if you like the energy theme, if you thought T was a buy at 9, well, you're definitely going to like it if it cracks below 7, 6, and or 5, right? So pay attention to it. If you get that deep retracement down into there, it is an addition for my portfolio. It's a buy here, in my opinion, just off of, their growth path alone. Very cheap in relation to what they're doing. Very bullish on this company, but 6 to 5 is when I add a little bit more heavily, in my opinion. If you liked Ondas at $15, you're probably going to like it a lot more at 8 to 6. 8 to 6 is my personal buy target for Ondas. If they give us the full retracement down into there, which would just be moving a bit closer into the infamous 12-month EMA and a bit more price action structure down here, I'd definitely be a very big fan of picking up some Ondas shares myself. EOSC and FLNC, I mean, my favorite of the two, we talked about these so many times, this one versus this one. My favorite one is FLNC, and consequently, after their earnings today, you can see that they made their way down into the mid-20s. It is an addition for me right now, mid-20s all the way down to low 20s into a very massive area of support. I like the battery storage plays. FLNC is mine, but I totally get anybody who's willing to play EOSC. Both companies have very attractive backlogs. It's just that FLNC has more revenue now and a larger backlog right now. Taking a look at some other companies, I mean, some of these other networking components, right? Down down a tremendous amount. Credo, we talked about if they lose this area, they're going a lot lower. What are they looking to fulfill? Well, sadly, they're going one level lower, guys. I mean, Credo had phenomenal earnings, and ever since their earnings, right, how much are they down? 55%. Very unfortunate. So Credo, you can see it on A-Lab, right? You see a lot of companies, just an absolute disaster right now. They are indeed, you can see it even on names like Celestica, which have been coming down significantly. These are some big winners from 2025, excuse me. So these are nibbles in my opinion, if we're looking for the further expansion of the AI thesis, which will be here for the next few years. And at these lower prices, they can be somewhat compelling because the forward growth is definitely still there. Some of the neo clouds, CoreWeave is, if you guys want a pickup, is a pickup under 80 for me personally. Nebius is a pickup right now, although they might move off of IREN earnings. They gave back the entire January and December push right there. And now they've just been selling off from 110 all the way down to low 80s, right? Under 80 to 70 bucks, well, let's call it 80 to 60, this entire price range is a screaming buy on Nebius for me if I'm looking to add. Reddit, I'm not really doing much on Reddit right now because although the valuation is compelling, I just think there's better plays in the market. And I have a problem with this EPS growth rate. If this EPS growth rate drops, right, well, then these metrics will not make sense. And at 213, it already traded at 13 forward price to sales, right? So keep that in mind. So Uber, Reddit, I'm not the biggest fan of right now. It's kind of losing price action levels one after the other. I'm a bigger fan of something like a Shopify. Now, Shopify reports, I know they're not the same company, right? But if we're looking just for fast-growing growth companies out there oriented towards tech and whatnot, the one that I'm looking for personally, like household names that everybody knows, is Shopify. Shopify down here, 115 out of roughly 100 bucks, is indeed a very interesting opportunity that I'm looking to explore in the near future. And we can talk about a few more themes here. We talk about Robinhood. We've talked about Robinhood so much on the channel recently. Is it a better valuation down here at 80? It is, but there's no support structure right here. And sadly, Robinhood has been coming down. I mean, like 35% of their revenues volumes is from crypto, and look what's been happening with crypto, right? So Robinhood just unfortunately following crypto to the downside, and this was quite nasty, and the prophecy has been fulfilled right now. The only problem is that there's no support. You got the 26 EMA down here at about 70 bucks. I'll read you the valuation for you guys in the next few days. As of right now, not very interested in Robinhood overall. I think the easy money so far has been made, and now it's a company that basically has to prove itself because at 110, it's trading for a 17 forward price to sales, right? EPS and the PEG ratio, I mean, it was quite high still, but even at 80 bucks, can you truly say Robinhood is a screaming deal? No, but maybe soon. We'll see. We'll have to revisit this one. And I mean, we're kind of running out of time, but tomorrow we're going to do some earnings as well. But tomorrow I may not have to do such a long introduction because I've spent all week talking about why the rotation is happening so far. So maybe what I can do tomorrow is skip over a long introduction, just get into earnings, get them over with quickly, and then spend more time on a potential list of buy candidates up here. I mean, we can talk about critical minerals, right? Whether it's USAR or quadruple U's or UAMY. There's so many of these companies out there, right? And the short answer is, are they buys? They are buys, but for a certain type of person who wants to buy them for the long-term thesis. If you're buying any of these critical minerals players, guys, keep in mind it takes a long time to ramp production for them. They do have government investment, either indirectly or directly. And we know Trump's doing the $12 billion vault. They are buys, but whatever you buy here, you need to be willing to hold for the next 2-3 years if you want to have the best gains. Not talking about short-term, but you guys know I never really talk about short-term, like level-to-level call options or things like that. But just for a thesis and narrative, critical minerals will be very popular, but it will take a few years to really get into, move away from the actual hype and narrative cycle into actual fundamental numbers supporting the narrative and the hype cycle, right? So keep that in mind. I mean, there are so many names that were down so much today. Throughout the video, we've talked about many of them, and these are just some of my impressions when discussing most of them, right? So we'll see what the market has in store for us tomorrow. But as I said today, the biggest winners of the day, I mean, it's no secret. I mean, Enphase had a very good earnings print. SMCI did as well. Eli Lilly did as well. But for the most part, guys, like such boring companies like Nike, some of the software names are up after being destroyed recently. But, so many companies that not many people do. FICO was up after yesterday. Look, UPS up was after being destroyed for like 4 years in a row. UPS has been one of the outperforming companies over the past 2 months or so. CP, a very boring railroad company, right? Which kind of came down. Look, they've been exploding recently because of that rotation. You know what I mean? Tractor Supply Corporation, same concept, right? And then some companies that were down in a disastrous fashion yesterday, they were actually higher today, you know? And then you just have a bunch of oil companies, some airlines have been bouncing back, company like Estee Lauder, you know what I mean? Some of the REITs like Vici, popular, coming off the lows. I told you guys about it. Brookfield, also popular company, although they haven't been rallying so much. But I mean, you look at names like, I don't know, like Kimberly-Clark, you know, Procter & Gamble. Right? Look at Procter & Gamble. It's running like Palantir. Not really, but you can clearly tell, right, what's going on here. Target, as we brought up earlier, right? UPS, which you looked at earlier. There's just so many boring companies. You know, Coca-Cola. Look at Coca-Cola. You know, breaking out like Palantir. Look at Pepsi. You know, so after like doing nothing from August through December, now when January kind of turned the corner right here, yeah, they went down initially, but then look, the rotation, man. And especially in the last few days, since Thursday, you can clearly see, right? Since Thursday, Friday, since they've been big rotating and big liquidations in all of tech, the money's rotating, right? But you can also tell by the degree of the rotations that money's not exiting the market, clearly not. And they're also not, I wouldn't necessarily say rotating to safety, because small caps have been doing fairly well. So overall, as I said in the introduction, guys, very strange market. A lot of liquidation breaks to the downside, but hopefully these videos give you a bit more clarity. And once again, I apologize for the late upload. Had some things to do this morning overall, but as I said, had some things to do before preparing the video, and then it took me a while to prepare the video. So in the forthcoming days and weeks, while I'm traveling, I'll be traveling the entire month of February. I do promise you guys that I will get the uploads out there for you guys before 10, 11 p.m. Eastern, because then I have to wake up at like 7:30, 8 a.m., then prepare the video, then film the video, and they're like hour-long videos, right? By the time they're uploaded, it gets quite late. Today was a bit of an exception, but I promise I'll be getting better for you guys in terms of the releases. But I know most of you guys now will just watch this on Thursday morning. Actually, none of this information in today's video is required to be acted upon with speed. It's just general understanding of the rotation and which companies are in attractive locations or not, and why. So that being said, guys, that's it for me. If you enjoyed today's video, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new. And then lastly, but not least, if you have any questions, comments, suggestions, feedback, anything like that, or if you guys are looking at certain plays, leave them down below in the comment section. I would love to read what you have to say for me. That's it for me, guys. Take care. Have a good one. See you guys tomorrow after the close. Amazon earnings, big one. Peace.